Hello and welcome to The Chatter. In this episode, we talk about rising rates and how they're affecting positioning, plus some insight as to just how bearish people really are. I was lucky enough to sit down with Global Head of Equity and FX Products at the CME Group, Tim McCourt. Hey Tim, welcome to The Chatter.
Yeah, thanks Jamie. Thanks for having me.
Yeah, good of you to be here. Now, we've been talking a lot recently about the sort of push and pulls going on in the market, particularly when it comes to rates. A lot of data we're seeing is looking like economic slowdown is coming our way, but bond yields are still rising. So the first question I wanted to ask you is, when you're talking to clients, and I know you're global head of, I think, equity and FX products, when you're talking to clients, is yields kind of the big story right now? I mean, is that what really people are focused on?
Certainly, when we're talking to clients, whether it's across equity, FX, or more broadly across some of the other asset classes, the rate story is certainly one that is impacting a lot of trading decisions, a lot of allocation, and has people genuinely curious about what this means for the markets going forward. And it's something that's, while it's a rate-driven story and maybe buttressed by some of the macroeconomic concerns around recessions, continued inflation, divergent policies across the central banks, it really is impacting all the other asset classes, and certainly what we're seeing in the equity market. Still weighing on equities as people are looking to revalue the fundamentals of what this interest rate environment means for equities, what it means for earnings, what it means for cash flows. And then that's presenting differently whether you're a multinational large cap or a more domestic focused small cap company here in the US. So it's really spreading into the other asset classes, and we see it continuing happen in the foreign exchange markets. Just last Friday with the major moves that we saw in the yen with some of the announcements out of the Bank of Japan, you can't really escape this story. It's really impacting a lot of the markets, a lot of the trading, and I think a lot of the perception about risks in the market that we're going to see in the next few months. So certainly a very, very interesting story and backdrop to keep everyone up to date on.
Yeah, and it's so interesting. You mentioned the sort of knock-on effect into other asset classes, because we often make this point that nothing really happens in a vacuum in markets. So yields going higher makes them more attractive, and equities, that they might take a back seat for a while. So how are your clients using your products? How are they using indices right now to sort of to manage what's going on in markets?
Yeah, certainly just to even reinforce what you said, I think one client summed it up best, where in these type of markets, there's no place to hide, right? There's really a lot of kind of this tension in the marketplace of needing to manage risk. Things aren't really performing that strongly in the equity markets. But the one thing that we are hearing from clients is that in this type of market, and it's really started even going back to late 2020, is the divergence in index price performance when you look at the global equity index benchmarks is really presenting challenges to clients where index choice matters. They have to be very precise about which derivatives and which indices they're using to hedge the totality of their portfolios, or where they're looking to maybe get back into the market on some of these downturns. It's not something where they could just sit back and use the E-mini S&P 500 as the universal risk management tool they have in previous bouts of volatility and downturn that we've seen with, multi-point differentials between NASDAQ and S&P. I think the Dow is outperforming some of the other indices by almost 10 percentage points this year to date so far. And you have mid caps acting differently than the large cap names. So all of these things really come together, that what we're hearing from clients is they have to be precise about their risk management. And that's one of the great things about CME, is that we offer all of the major equity index benchmarks on one platform. So lots to choose from. But the cost of being lazy, for lack of a better word, has certainly increased in these markets, and they really need to pay attention to which specific risk they're managing.
So that's really interesting. You've seen a material change in investor behavior where people are getting a lot more precise about not only on the long side or the way that they're protecting themselves. Do you want to go into a bit more detail?
Sure. And it's not even just about whether or not they're managing certain risks in their portfolio or trying to be precise about the points they're trying to deploy new capital in these markets to generate return. It's also in terms of product choice. When we look at the precision, it's both a function of index, but also things on the option front of which day of the month you're looking to it. We've seen a continued move to shorter and shorter dated options. We've had very strong success at CME offering the daily contracts, where we now have Mondays and Wednesdays and Fridays on most of the contracts, but we now have Tuesdays and Thursdays on the S&P and NASDAQ, and evaluating it on some of the other indices, because this cadence at which these market moving events are occurring no longer are comporting to the normal cycles that people are used to. You have market moving events happening at night. You have earnings throughout the day, different economic announcements happening throughout the week. So that precision of the day of the week matters. And then when you couple that with which index you're trading, I think these are really things that are of benefit to people. And it's whether or not you're managing risk or trying to be opportunistic about being in the market, everyone is benefiting from that precision. The other thing we've heard is also that they like at CME is the advent of the micro E-minis that we have in equities. They also now have multiple size contracts. So you think even if you're a large institutional trader, you're used to using the traditional E-mini. But if you're trying to manage inflows and outflows or cash equitization programs in these type of markets, everyone can benefit from now trading a much smaller size contract versus having to wait or rolling up a few $100,000 to trade a few E-minis. You can now allocate and risk manage in tens of thousands of dollars versus hundreds of thousands, which is of great benefit to market participants, particularly on the buy side, who have such more rigidity in the programs they're looking to manage in these type of markets.
And if I could change tack just slightly, Tim, I wanted to ask. I'm having a tough time working out positioning, to be honest, because there's a lot of rhetoric out there that fear is now as much as it's been since 2008. But then I look at other reports and it feels like, we haven't seen panic yet. I think there's a lot of short interest out there in the markets, but a lot of that is just hedging as people are looking to pick up single name stocks that they think are looking cheap. So I just want to know, what's your gut feel? How are people really positioned now? And are we really seeing the fear that we saw in 2008?
I don't know. It's a great question. I mean, my crystal ball is broken, so not sure what's going to happen in the future. Where if I had one, I'd probably be in a very different position.
Just call me first, Tim. Okay.
Yeah, absolutely. So I think what's interesting is when we look at it, I think the market feels really tumultuous, and it certainly is. We've seen the return of volatility to the FX markets coming off a very sustained period of historic low volatility. We've seen volatility remain elevated in equities, but not necessarily the same levels we were receiving even a year ago, or certainly at the height of the pandemic. So when you're looking at the implied volatilities of the market, sure, above average, above recent norms that we saw for most of 2021 and the beginning of 2022, but certainly nowhere near the episodic bouts of volatility we saw at the start of the pandemic in 2020, or some of the market moving events we saw in equities in February of 2018. So I think, the persistency of the vol, but the relatively tight band it's been trading in is something where I believe the market is saying there's more to come, but not necessarily sure when or how it will manifest. I think people's anxiety remains strong. I think people's uncertainty remains strong. And that's why you're seeing so many people really be precise about risk management, hedging, making sure they know exactly what they're getting into. So I think time will tell as we're finding our way through the fourth quarter of this year here. But certainly when you look at it in recent events, it's high, but nowhere near as high as in the equity markets that we've seen in the last 18 to 36 months. So we'll have to see how it goes from here. But as we head into earnings season here in the US, I think there's going to be a lot of attention to the fundamentals of what earnings has to say. And that might provide a clue to market participants about what we're in store for the rest of 2022.
You just mentioned it there, Tim. And if I can borrow you for just a couple more minutes, what are you really focused on in terms of what direction we take next? I mean, obviously we had the Bank of Japan trying to intervene. I'm not sure how much a difference that made. So dollar yen is on a lot of people's scorecards right now. Obviously economic data, but as you said, it's earnings from corporates. So what have you really got your mind focused on over the next few months?
Yeah, I think for me personally, and when we talk about the team here at CME, I think there's going to be a lot of interest in the continued interest rate policy in the market. But I also think how the narrative and how the data is supporting this idea of, is a recession coming? When you're looking at major markets like whether it's the UK or the US or the Japanese economy, I think this tension between the rates policy, inflation expectations, but the actual economic fundamental performance, I think that how that tension between those variables plays out is going to be telling about both the volatility regime we find ourselves in, as well as the direct price movement we see, particularly in the equity and the FX markets.
Well, Tim, that is some really great feedback and some really good insight into the market. So I just want to say thank you so much for taking the time to chat with us.